My guest today is Nick Keegan, a co-founder and CEO of MailMetrics. Thanks a lot for coming to the podcast, Nick.
Thanks for having me. Delighted to have got it scheduled in event.
Yeah, you have a wild journey. You started this business back in 2013. It took you 7 years to get to 1 million in revenue. You achieved that back in 2019. Then you did 40 million in 2023, and now you're on track to do 200-ish million. This is the power of organic as well as growth through M&A. Please take me back to the early days. What were you doing before founding MailMetrics, and then maybe later, what problem did you try to solve so you end up starting MailMetrics?
Sure. So this is my first business. I started the business when I was 24. So prior to MailMetrics, I wasn't doing much. I was in the Army Reserve. My plan was to join the Irish Defence Forces as a career. So I joined the Army Reserve in a part-time capacity to prepare for a career, full-time career in the Defence Forces. And in Ireland, it's a very small country, very small Defence Force, and it actually can be quite difficult to get into the Defence Forces. So I was trying to join the Army as a commissioned officer. It's a very select number of people get accepted every year. So whilst I was waiting for the next recruitment competition to open up, myself and a friend of mine decided to start a business. And we didn't really think it would go anywhere, to be honest. The initial idea was a mobile app for consumers that would consolidate all of your household bills and statements into one sort of easy to use app. So instead of going to your telephone provider to get your phone bill, going to your gas provider to get your gas bill, your insurance company to get your insurance renewal, you'd have one app on your phone. It would make it easier for consumers to manage all of their correspondence and their bills from their service providers. So we established a business in 2013. We effectively went out to look for investors, somehow managed to convince investors to give us 700,000 euros in seed funding. And we went about building this business essentially, but it totally failed. You know, the business model was totally flawed. We didn't really think it through very well. The problem with the app was it solved a consumer need. So consumers generally, the feedback was, yes, we would love to have one location where we can manage all of our correspondence and our bills and statements, but they were not willing to pay for that. And the service providers, they didn't want their customers going to our app. They wanted their customers going to their website where they can upsell and cross-sell. So the business model was fundamentally flawed. So for the first 3 years, we pretty quickly burned through the cash and, almost went out of business, I suppose, because we didn't raise a single invoice. We never brought in a single euro in revenue for the first 3 years, which was a pretty tough time, you know.
What were the days look like? I mean, 3 years, it's quite a long journey. You were young, you were 24. What were you doing? You come in the office, what do you do?
Not much. So my two business partners, Marcin and Pavel, they're two Polish guys. So they were based in Warsaw. So I would go to the office every day. I had a small little office, one person office, and I'd have no emails coming in. There wasn't much to do, you know. But we were trying to figure out, would we pivot? How would we pivot? We couldn't agree amongst ourselves. Should we just let this idea die, or should we just keep trying to find a different angle? So we just kind of cruised along for a couple of years, and we were trying to sell this product for a long time, and we would get pretty good initial feedback from banks, insurance companies, etc., who would come and meet us, and they'd want to understand the proposition because they did want to have more digital online communications with their customers. But once they found out it was like a consolidation app, they kind of lost interest. And then one day in 2015, the phone rang. it was an insurance company that we had pitched the idea to in maybe a year and a half previously. And they just said, we have a tender coming out to the market. We have an opportunity. And basically what problem they were trying to solve was that they had a mail room in their basement where they were printing and mailing millions of letters a year to their customers. They wanted to outsource that mail room. And then they wanted to digitize as much of that communication as possible. They asked us, is that the kind of thing that we do? And we said, that's exactly what we do. And we just pivoted in that direction. And effectively, we won that contract. And from that point on, that was the business model.
And today, MailMetrics helps highly regulated financial services companies, banks, insurance, pensions to engage with their customers. Has it changed over time since the first customer?
Not really. It's it's grown and evolved, but the core service offering is the same. We help highly regulated companies, so as you say, banks and pensions, to communicate with their customers through various different channels. So if you are a consumer that likes a fully digital experience, you can go online, you can buy your insurance, you can apply for a mortgage through an end-to-end digital process. But equally, if you're somebody maybe of an older generation who prefers to do everything offline through paper, so getting a letter in the mail, sending back some forms, we facilitate all of that too, and that's all controlled by our software platform to ensure that these organizations are meeting their regulatory requirements. But I suppose our core USP is helping these organizations to move as much of that communication towards digital channels without them having to change any legacy systems.
And what is the story between the first and the second customer? Because you've said in one of your previous interviews that it takes extremely long time to close this client.
Yeah, it can be 12 to 24 months sales cycle. We've had customers we first spoke to 4 or 5 years ago that took them 4 or 5 years to close, because they're large, often slow-moving, conservative organizations. They would effectively be giving us their most sensitive customer data, and they don't do that. They don't do that lightly. So it's quite difficult to grow organically when the sales cycle is so long, and to build a pipeline when the sales cycle is so long. So, we got lucky with the second customer, whereas somebody that worked in the company that was our first customer moved somewhere else and said, this is a good solution, we should bring it in here. And once you have a couple of customers that are well known, you have a case study, you can go and explain what you've done for somebody else, and that's really helpful,
And it took you 5 years to get to 1 million in revenue, and
7.
The period between 2000. Sorry, yeah, and the period between 2019 and 2023, crazy growth. So what did you change?
Yeah, so acquisitions, basically. So from 2013 to 2020, our growth was purely organic. And we struggled for a number of reasons. The long sales cycle, the fact that we were a startup meant we didn't really have a huge amount of credibility. As I mentioned, it's very sensitive data that these organizations are giving to us, and we didn't have a lot of credibility being such a small business. And when I explained earlier our model of, in our first project, we took over this mail room, printed and mailed all of the letters, and did the digital communications also for this insurance company. We didn't actually print the letters. We had a partner that would print the letters for us, effectively a secure print and mail business. And we were working with that company for quite a while. And we realized that a lot of the target customers on our list were actually customers of our printing partner. So we wanted to sell digital communication software to these businesses. Our printing partner was printing and mailing letters for these businesses. And we thought to ourselves, well, why don't we just buy our printing partner and go to their customers and say, you're spending €1 million a year mailing letters. Why not use our digital solution and, cut that in half for 66% reduction in spend? And that's where the idea came from. So we bought our first business in 2021. We actually bought two businesses in 2021, one in July and one in August. So we bought our Irish printing partner, and as we were going through that process, my conviction that this was the right way to go really grew. So we found a similar business in the United Kingdom that we also acquired a month apart. We initially were negotiating with both of these businesses, thinking that one of them mightn't come to completion, but actually they both came away at the end. And so we acquired both of those businesses in 2021. And we've seen massive growth on the back of those acquisitions. And we just seen the strategy was actually starting to work. And so we've just doubled down since then. And we've essentially done an acquisition a year since 2021.
Could you share the few things about the first two acquisitions? First of all, how many companies did you approach to show your interest of acquiring them? How did you finance the acquisitions? I guess those companies were larger, at the same size. And what was the structure? Did you acquire like 100%?
So we didn't approach very many. The Irish business was a partner of ours, so that was a very straightforward discussion. So we just approached them directly, and we negotiated a deal. The UK business was the only UK business we approached, the first one, and we got pretty lucky. I think they were a very good fit. So we didn't really cast a wide net. The first two businesses we approached, we were able to do a deal with. In terms of the structure and the financing of the acquisitions, so we were approximately 2 million in revenue at the time, 200,000 net profit. And we were trying to buy a €5 million turnover business in Ireland with €1 million in EBITDA, and a sort of £4 million turnover business with 700,000 in EBITDA. So because we had a pretty poor start in the first 7 years, we didn't really do much. Equity investors weren't particularly interested, and we would have had to give away so much equity just to fund these acquisitions, it didn't make sense. So we decided we would debt fund them. Our pillar banks, the main high street banks, were also not interested because they saw it as too risky. But we found an alternative lender that was willing to debt finance the entirety of both acquisitions, but they were essentially loaning against the EBITDA of the businesses that we were buying, because we had nothing. Like, we had 200,000 in net profit, so we had no way to fund the deal otherwise. So we took on, I believe it was €5 million to fund both acquisitions, and we pretty much structured them the same way, where 60% was upfront consideration, and the balance was on an earn-out over 2 years. And the earn-out was simply no growth factored in. We just want to ensure the EBITDA that we've bought is maintained over 12 and 24 months. And if that EBITDA level is maintained, you get your deferred element of your payment.
And how did you feel? I mean, stress-wise, taking on lots of debt, and and this was your first and second acquisition. You haven't done it before.
Yeah, so I think the other important thing to say is the fact that nobody else would fund the acquisitions, and we found an alternative, almost like a venture debt type lender to fund the acquisitions. The interest rate was very high, so we effectively paid 20% interest when you look at sort of drawdown fees, sort of early repayment fees, your sort of margin, and so on and so forth. When all was said and done and we refinanced the money out, we effectively paid 20%, maybe a bit more. But I suppose from a stress perspective, initially because I'd never done an acquisition before. I had no knowledge about how M&A worked, so I was really learning as I was going. But we hired a good CFO. We took a corporate finance guy from Deloitte who was very familiar with this world, and he helped us to navigate it. And we'd modeled it all out, and we were pretty confident that the businesses we were buying, very kind of sticky, recurring revenues, good EBITDA margins. So we were confident that as long as our modeling was correct, which it was, and as long as these businesses didn't fall off a cliff after we acquired them, we had enough headroom to cover our debt repayments. But it was during COVID as well, I suppose, right? So I was signing these loan agreements from my kitchen table, and whilst the whole world was going down the drain during COVID, we were taking on a large debt facility. So it did give us, you did stop and think for a second, is this the right thing to do? But thankfully, it worked out very well.
But what about the earnout and everything, and the people you bought this business from, and how is it on your industry? Are you the younger guys? Are you the older guys? How is it overall? And how traditional are those businesses, and for how long history they have?
Yeah, so I think we're probably the younger guys in the industry. The first three businesses that we bought, they were founder operated, and the founders were looking to retire. So generally men in their 60s who don't have a natural succession plan. The most recent business we bought was slightly different because that's gone through a number of private equity. It's changed hands over the years. But generally speaking, these were kind of owner-operated businesses. Were guys at retirement age. So I think the businesses that we are buying are printing businesses, and there's not a huge market out there for these types of businesses because investors are concerned that digitization is going to destroy these businesses. And I suppose from our perspective, we have a digital platform, and whilst that is a risk for other people, that's an opportunity for us, if that makes sense.
And what about, obviously, tons of synergies? What and how much do you change post-acquisition? Yes, you reach out to those same customers offering other services, but how does it usually work? And do you have like a playbook or a 90-day plan, or how has it been so far?
So we've done both a good job and a bad job of acquisition integration over the years as we've made mistakes and we've learned. But we fully integrate these businesses into the wider group. So we have one exec team, one senior leadership team, and it's a fully integrated functional structure by the time we're done. We don't have a playbook necessarily. Like we have a strategy that we follow. It's a 4-pillar strategy where we acquire these businesses. We do avail of certain synergies by integrating them into a wider group. We onboard them onto our technology platform. We sort of improve pricing models and margins, and we drive digitization. So when we buy one of these businesses, we're trying to navigate them through each pillar of our strategy. And each of those pillars effectively drives enterprise value, and it helps us to transform the businesses that we've bought into something much more valuable once we're done.
Now, to understand the timeline, the first two acquisitions were in 2021.
Yes.
July and August. What about the next ones, and how many you've done so far?
So, first two 2021. 2022, we spent the year trying to figure out what we've done and how do we operate and run these businesses. So that was a difficult year. But by 2023, we were able to come up for air, and we made our third acquisition in 2023. So that was another Irish business that doubled us in size to approximately 40 million turnover or revenue. And then in 2024, so December 24, we made our largest acquisition, a large UK business called Adair, and that brings us to around 210 million in revenues at the moment. So 4 acquisitions in total since 2021.
And how much can you improve the bottom line post-acquisition, as you have so many synergies and every acquisition brings you new customers, which you can offer new services. So how has it been working out?
So whilst there will always be cost synergies, we never actually bake any cost synergies into our model. So we don't assume any cost synergies at all, although we know they will come. So when we underwrite a transaction, we're not relying on 1, 2, 3, 4, 5 million in cost synergies. The big win for us is gross margin improvement. So if we buy a business that's sending 100 million printed communications, if we can convert a certain number of those communications to digital channels, it's obviously considerably more profitable to send a communication electronically than it is to send something through the post. So for us, even if the top line never changed and there was no organic growth, if we can just migrate customers from print to digital channels, that's where the real synergies come in. So it's a really interesting model where we can buy these large, long-term, sticky contracts, and by migrating them to our software platform, we can effectively drive up the gross margin considerably, which then falls to the bottom line, because we don't have the same requirement for fixed overhead of sort of printing equipment and all the FTE that goes with that.
What about the feedback and the partnership with investors? Because you've been doing that for such a long time. Don't they want like liquidity? Don't they push you to sell the business to similar competitors, the ones you've bought? Like, how has it been this over the years? Because the start for you, it was extremely long.
The investors that we took on in 2013 or 2014, I think we closed the raise, they were angel investors. And a lot of those angel investors we would have bought out over the years because the business wasn't performing. We didn't have a huge equity stake, and we would have went and negotiated with those guys and bought most of them out. A number of them stayed in, and they effectively said, look, we're treating the money like it's gone. We're just going to stick around for the ride and see what happens. So it was only last year in December 24 when we acquired Adair that we took on private equity. So this is our first time having, I suppose, institutional investors come on board.
The third acquisition, it was bigger than the first two. It almost doubled the business. How did you finance this acquisition?
Debt also. So we were able to structure it in such a way that we could fully debt fund it. So when we made the first 2 acquisitions, I mentioned we used an alternative debt fund, high interest. Within 12 months, we brought the businesses together. We had proven out the combined EBITDA of the business, and we were able to refinance that debt with Bank of Ireland, the largest kind of high street bank or pillar bank in Ireland, at much lower interest rates. Like you're talking 3% as opposed to the 20 that we were paying previously. Now they've increased since then, obviously, but at the time that was a huge shift for us. And that same banking partner funded our third acquisition, where they fully debt funded it. And we also had a deferred element whereby I think it was 20% of the acquisition value or something like that was held back on an earnout. So we were able to go from like 2 million in revenue to 40 without selling any additional equity, fully debt funded.
When doing those acquisitions, in which, like, post-acquisition, you have your period, you said year 2002, you were figuring out like how you were going to manage it all. In which moment you always decide that, okay, it's time to buy another business? What has to be, what has to come true?
I suppose we don't have a formula necessarily, but it's more of when you're putting out fires every day, or if things aren't operating smoothly, you're very much focused internally on the operations and trying to make sure the business is running smoothly and customers are happy, and you're delivering on your obligations to your customers. Once all of that quietens down, so the new structures and processes are in place and they're working, and once that noise kind of dies down, it's not always like that. Sometimes it's quite a smooth transition. But I think for me, after the third acquisition, probably a year later, things were running well, things were going smoothly, and we started to look for our next acquisition, I suppose. Now, I'm always on the lookout, so even as I'm negotiating to buy a business, I'm meeting other owners of other businesses, and I'm always trying to keep that pipeline full, because again, that's a slow process. It can take a while to get these businesses to into the mindset of selling, and to get them through that funnel.
What are usually the 2 to 3 factors, important factors you analyze first before making the acquisition? Number one, and what are like the biggest risks when doing acquisitions, even though you have so many synergies and you can again have those new customers coming in who you can start serving right away?
First of all, it's the type of customers that they service. So are they servicing highly regulated financial services, utilities, health type customers? So any kind of marketing communications or anything like that, we're not interested in. It has to be sort of transactional communications for regulated entities. Then we're looking for businesses that can effectively fund themselves. So ideally, we can debt fund these businesses and use the earnings from the business to repay the debt that we've used to acquire them. And one thing that we've learned over the years is cultural fit. So, a business can look like the perfect fit on paper, but if there's not a good cultural fit, you're going to spend 2 to 3 times longer trying to integrate the business. It's going to be so much more painful. So whereas we would have acquired businesses before where we kind of knew it wasn't a good cultural fit, but everything else, all the other boxes were ticked, we'll walk away from a deal now if we don't feel there's a good cultural fit there. Yeah, then in terms of the risks, I suppose we see these acquisitions as relatively low risk, because oftentimes the customers that we're acquiring have been customers of the business for 10, 15 years. Very, very sticky, very difficult to move, which is why it's hard for us to grow organically, and which is why we acquire these customer contracts through acquisition. But oftentimes there can be customer concentration. And so whilst they are sticky and they're hard to move, if there's any sort of challenges post-acquisition, any integration challenges, and one of these customers decides to leave, that's what we're always very aware of. So we don't like to enter into an acquisition where there's too much customer concentration. Or if there is, we try to structure the deal in such a way that it gives us some downside protection, to sort of mitigate that risk.
Obviously, there has been things which hasn't gone as planned post-acquisition. One thing you said is the importance of culture. What else? I mean, has there been a strong, a drop in revenue for various reasons, or maybe you thought that those customers will convert into your customers as well, the one you acquire under the new company? Has there been any larger problems, so-called?
So of the 4 acquisitions we've done, 3 of them have gone very smoothly. We've had one acquisition that wasn't a bad acquisition, but it didn't go as smoothly as we would have hoped. Pretty quickly after closing the deal, EBITDA dropped by maybe 20 to 30%, which is quite a big drop. And we had some sort of integration issues around culture, and there was a lot of pushback and resistance. But we never got into a situation where we couldn't meet our banking covenants or anything like that, because we had paid down a lot of the debt from previous acquisitions. The business was growing organically, so we were in a pretty strong place to navigate that. But it was an important lesson, because it wasn't certainly wasn't a fatal lesson, but it showed us actually that these acquisitions don't always go 100% to plan, whereas we've been maybe pretty lucky previously. So it probably gave us a different perspective on things. So I think one acquisition was more challenging. It's back on track now. Thankfully, it's fully integrated, and it's in a really good place. But in the 12 to 18 months post acquisition, it was pretty challenging one.
Can you share what happened cultural wise, or you prefer not to?
No, it's when we acquired. So these businesses are around for a very long time. I think all the businesses that we've bought have been older than 30 or 40 years old. So pretty long-standing businesses with a lot of tradition and particular ways of doing things. And they don't experience a lot of growth, generally speaking. Whereas we're a fast-growing, fast-moving business. We like to come in, make a lot of change, implement our ways of doing things. And if you have a management team that is excited by that and excited by change and new opportunities, they'll do really well working with MailMetrics. But if you've got an organization that their attitude is like, this is the way we've done it for 20, 30 years, we don't need to change, who are you guys to come in and tell us how we should run the business? That's pretty much the situation we found ourselves in. So it's not that these people were bad people necessarily, it's just that they weren't the right fit for our culture. And when you're buying a small business, oftentimes the owner and the one or two people directly, the one or two senior people who report directly into the owner, they're so critical to the business that if they leave, it leaves a really big void and a big gap. So actually what I found over time is the larger the organization you acquire, it's almost easier in a lot of ways. My perspective on that 4 years ago would have been, I want to start small because I want to find my feet. But when you buy a larger organization, if one or two people leave, there's a machine behind them that keeps the organization going, And certainly in some of the smaller businesses we bought, and particularly the one where we had the cultural misalignment, that was pretty challenging because the one or two people at the top, I suppose we didn't have the same outlook on things.
What about the largest acquisition? How long was the process? When did you approach this company, and why did you decide to bring on the private equity? Was it because of the size of the deal, or were there other reasons for doing that?
Yes. So the process was quite long. I think we initially started talking to this business in early May 24, and we closed it in December 24. I think for us, we had grown the business in Ireland to be the market leader. So MailMetrics was the market leader in Ireland by 2023. And we wanted to really expand outside of the Irish market. So we were looking to our closest neighbour in the UK, and we wanted to make a platform acquisition in the UK, something of real scale that we could use to grow into the UK market. And Adair SEC was a business that we had always had our eye on. We thought they'd be an interesting fit. I wasn't sure whether it would be possible for us to make an acquisition of that size at the stage we were at. But from speaking to the guys in Adair, there was a really strong cultural alignment, which was very, very important to me. But equally, they had made that shift of trying to promote digital communications and not just printed communications. So we knew that there wouldn't be any resistance or pushback there. And when we went to, we effectively trashed out a deal with Adair that we both felt was fair. And then we went to try and fund the transaction. And our banking partner, who had funded our previous transactions, the check size was just too large for them to fully debt fund it. And even bringing in a second bank, they wanted to see equity investment coming in. And I think even for us, we always planned to take on private equity. So it was the natural was a natural point for us to say, okay, we've built something of scale. We've a really big acquisition opportunity here. We want to continue to work with our banking partners because they've been really good to us, but they want to see some private equity coming in. We always planned to take on private equity, so this is the natural time to do it. So we ran a small process, and we effectively landed on MML equity partners from Dublin. So really good guys who helped us throughout the acquisition process and after, so it's been a really good partnership so far. Although it's only been 2 or 3 months, we're really, really excited to work with the guys in MML over the next 5 or so years.
Yeah, that would have been my next question. Was this acquisition just for this one, or the idea for you is to now like buying bigger and bigger companies? Because in one of your previous interviews, you mentioned like 1 billion enterprise value, 1 billion revenue.
Yeah, so I think we will continue to be acquisitive into the future, but I think the acquisition we've just made is such a transformational acquisition that we're going to pause for a moment, and we're going to really focus on integrating that business, because we have grown the business multiples of where we were last year through completing this acquisition. And, we're now one of the dominant players in the United Kingdom. We're certainly top 3, if not top 2. And before we look to the United States or any other markets to make further acquisitions, we want to make sure that the one we've just acquired is fully integrated, and that we've really got their customers have been onboarded to our software. We're driving that digitization of the communications, and then we can really prove out the model. So I think in the very short term, we're going to focus on integration, but absolutely we will look to acquire again in the future. And, I'm still actively speaking to potential acquisition opportunities just to keep that pipeline strong and make sure that doesn't fall away.
How has your role changed over the years?
A lot.
At each level, maybe you can share.
Yeah, so in the first 3 years, I did everything. So I was the CFO, the CEO, the chief revenue officer. Everything was me, because I was the only founder who wasn't technical. So all of that fell to me. Didn't do a very good job of a lot of those things either. When we were in the 1 million revenue range, I was the key point of contact for every single customer. All of the issues and problems got escalated to me. I was effectively the customer, the key account manager for all of these large customers that we had. And then once we moved into the M&A phase, I focused much more externally. So raising debt funding, meeting potential acquisitions. And we'd managed to build a team around me that ran the day-to-day business. And it meant that I didn't need to worry about fighting fires or sort of people issues or integration issues so much anymore. And I think that's been a really big part of our success, that I don't need to be involved in everything anymore. And naturally, when you get to the size that we are, it's impossible for me to be involved in everything. But in the very early days, that's how it is, and it can be very difficult to back yourself out of that. So I think we've done a good job. It wasn't easy, and there was a lot of teething problems as I backed away. But certainly, I think my role has gone from being like an operator of the business, sort of rolling up my sleeves and actively working in the business, to working outside of the business in terms of strategy and acquisitions, fundraising, and so on and so forth. And I've really enjoyed that change, because I think I'm much stronger doing what I'm doing today rather than in a more of an operational role.
To understand a bit how you think about opportunity and investing, and maybe your decision-making framework, what's maybe a contrarian belief you have about investing, building or acquiring businesses that many people would disagree with, and based on your previous 5-year experience, because you were always growing organically, very slow growth, and then in 5-6 years, like boom, like crazy growth.
What I found interesting is when we decided to start acquiring these printing businesses, people told us we were crazy because you're a software business, you're going to acquire a print business. Like, why would you do that? And I think when we looked at the fundamentals of these businesses, they've got sticky blue chip customers, long-term recurring revenue contracts, good margins, kind of very sort of resistant to economic recession because you need to get your insurance renewal, you need to get your bank statement. It's not discretionary. The only downside of these organizations is that they're printing and mailing a letter from an investor's perspective. So we've seen a lot of value in these organizations. And I think actually, if you think about investing, and to circle back to your question, I think there's a lot of opportunity in more traditional businesses that have good fundamentals, but could do with a layer of technology being introduced to their business model. And that's effectively what we're doing. We're buying communications businesses. It just so happens that they can only offer one channel of communication, print and mail. So we can buy these businesses for, very good value. And by introducing our technology and by tech enabling these businesses, we can significantly drive up the enterprise value. So, I suppose it's counterintuitive in a way because we're acquiring businesses and we're cannibalizing them. But actually, I feel there's something in that. There's a model there whereby you can take a service-based business or a more traditional service-based business and introduce technology in such a way that you move it to more of a tech-enabled service business. And I think there's real value to be had there.
And what's your view on leverage and how has it changed over the years after all those acquisitions and now having those private equity people on board? How much debt is too much? How much is too little? What are your thoughts?
So we have always borrowed within what our funding partners would allow us to borrow. So generally 2.5 to 2.7x debt to EBITDA on the high end. So I don't think that's crazy leverage, at least not from my perspective. And that allows us to sleep at night, that we've got enough headroom here to cover our repayment obligations. As you start to move away from a sort of high street bank to a alternative sort of venture debt type facility, you can start to get into much higher levels of leverage, which I wasn't really comfortable with. But I suppose it also depends on how it's structured and so on and so forth. So there's a lot of nuance there to consider. But certainly, even with our private equity partners, that hasn't changed. Like, our debt to EBITDA ratio is still very low, which is demonstrated by the fact that sort of a regular high street bank is able to fund that for us. So so I think that's pretty much it. Like, we've tried to keep it relatively low. All of the debt funding that we've taken on has been a mix of interest only and amortizing. So we are paying down the debt as we go. So generally, there's a bullet at the end of maybe 50% of the acquisition cost, and the other 50% we'll amortize as we go through the term of the loan.
There are a lot of holding companies out there. When you look in Sweden, for example, they have very diversified portfolios, but you've shown like an extremely good example of just being like extremely niche business and just dominating this. So my question, like, when you look at the maybe other businesses, other industries, what maybe signals tell you that there is an opportunity worth pursuing, doing something you have done?
I'm not sure how to answer that question. I often think we've done a pretty good job of executing this strategy. I often think to myself, if we were to exit this business, like, what would I do next? And like, I'm a very simple man. I think if something works, just keep doing it. So I'd probably look for another opportunity where there's a fragmented market, that we can apply a roll up and sort of build something of scale. Again, I like the idea of buying service businesses that could benefit from sort of being tech enabled and developing some software product that sits above the service to automate or give a better customer experience. So that's where I'd be looking. But I don't know. I suppose I'm very focused on what I'm doing now. But certainly, I think if I was to go again, I'd be looking for the characteristics of what we have here. Fragmented industry. Ideally, something that's not the new hot thing, that everybody wants to get into and acquire. Like, we've managed to find a little part of the world where nobody else is too interested in it. And, it means that despite some of the challenges that we face, we've been able to build a really strong niche here.
And the personal question, how has been your work-life balance while going all through all this craziness over the past 11 years?
Probably not great, to be honest. So I had my first child in December 2023. So for the first year of his life, basically, we were working on this last acquisition, the big one, which was a lot of sort of early mornings, late nights. So there's peaks and troughs. When it's normal day to day, it's not too bad. But when we're working on a deal, it can get pretty intense for a number of months. So I think I could do a lot better with work-life balance. I'm trying to make more of an effort on that now since my son is here. I'm trying to make sure that I'm home and present and I'm around and I'm not coming home too late and so on. But that's a work in progress.
Okay, so what about MailMetrics today? Could you share some numbers? What is the plan for 2025? And what is the plan for maybe, let's say, year 2030? Is it the plan to exit one day? Is it plan to do an IPO? Because you now you're working together with private equity. What is your plan?
We're about 210 million revenue now. We have in excess of 20 million in EBITDA. I suppose our goal over the next, in terms of exiting, right? So we will exit the business eventually. I think that's sort of preordained when you take on private equity. There's a natural time horizon there where the private equity need to get out and sort of realize their investment. But certainly from my perspective, I see myself going on and on and on and on for a number of iterations here. I'm still young. I'm 36, so I've got a bit of road left to go. So I could see myself doing another 2 or 3 sort of iterations of this for private equity. I think we can build this to a 1 billion revenue business through M&A. Not only through M&A, but largely driven by M&A. There are a number of players in our industry in the 1 to 200 million revenue mark who are struggling with digitization and they don't have a strong, compelling proposition. And we can effectively acquire these large businesses, very good value, and sort of transform them with our technology platform. So I think we've stumbled upon a massively scalable opportunity here. And we're just really excited about executing on that plan over the next 5 to 10 years. And I think when we would have said 1 billion in revenue 2 or 3 years ago, people probably chuckled a little bit and said, that's maybe a bit ambitious. But we're 20% of the way there now. So I think it's probably a little bit more realistic now when we say it.
So you're 36, you're a simple man, as you said. You first find what works and then you just keep doing this. Do you sometimes get a bit emotional, do you pinch yourself of what you have accomplished over the past 10 years?
I'm my own worst enemy for that, so I always move the goalposts. I set goals and then I move the goalposts as I get close to reaching my goal. So I often don't stop and look and reflect on kind of where I am. But I moved house recently, and when I first had the idea of introducing an acquisition strategy, I wrote a bit of a business plan, more so just to formulate my own thoughts and get them on paper. It helps me to think through these things. And I found the business plan, and I think we had projected that we would make so many acquisitions, we'd reach 50 million in revenue, and we'd have like 10 or 20% EBITDA margin, And I remember when I wrote that plan, thinking to myself, if we only achieved half of this, it'd be absolutely incredible, you know. And in the time periods that we'd set, not only did we achieve it, but we've more than exceeded it, you know. So that was a nice moment to look and reflect and say, Jesus, we've actually come a long way. And I am proud of what we've done. A lot of luck involved, a lot of sort of good fortune, but it's been an amazing experience, and I'm really looking forward to seeing where we are in the next 10 years.
Me too, Nick. Quick fire questions. What is your favorite book, and what is the best investment advice you've ever got?
My favorite book, I'm gonna pick a business book, right? Because probably the book that had the biggest impact was Traction, the EOS book. I'm not sure if you've ever read Traction, but it outlines the EOS framework, which we introduced into the business in 2019. And that's facilitated a lot of the growth that we've had over the last few years. So it basically put in place a lot of the systems and the frameworks that we use to run the business day to day. That book was incredibly helpful to us. So Traction by Gino Wickman.
And the best investment advice you've ever got?
Don't lose money. Best investment advice I'd ever got. I'm drawing a blank on that one.
Okay, that's fine. So Nick, thanks a lot for doing this. Finally, we got it done. You have a crazy journey. We started this. I pitched you to come to the podcast before you made your recent acquisition. So very happy that we could do it after this one. So thanks a lot for doing this, and more than happy to do it again very soon after your another acquisition.
Yes, absolutely. Let's certainly keep in touch. Thank you for your patience, because I postponed this a couple of times, so I appreciate your patience, and thanks for having me on. It's been a pleasure, and I've really enjoyed chatting to you.